Hi, this is the first video of a four-part series on analysing stocks. And in this first video, we're going to be talking about PE ratios. The first thing we'll be discussing is how to calculate the price to earnings or the PE ratio. The next thing is, what does that tell you about a stock? And the third thing is, how can you, as an investor, use it? Starting off with the calculation. So the price to earnings ratio is quite simply the share price of the stock at any given time divided by the earnings per share. And the earnings per share, or EPS as it's usually abbreviated to, is the company's profits over the last year, or the income or profit it's made, divided by the number of shares on issue. So you know how much each share actually has as a kind of share of the profit. So when you do this calculation, you can find out how expensive a stock is. That's the PE ratio. So you can see the higher the PE ratio, the more expensive the stock, because there's going to be a big discrepancy between the share price and how much the company's actually earning. Let's see an example here, using Danone, the big French food company. So their PE ratio is calculated as the share price, which was around 66 euros 44 cents, divided by the earnings per share in the company, and that's most recently for the last 12 months, €2.95. So if you do that, you get 22.5 times. So as you can see, if you buy a share, you're buying it for 66 euros 44, and the actual earnings at the moment, potential per share, is 2.95. So you're getting that multiple, you're paying 22.5 times what the business is earning in 1 year for the shares. And because when people own a business, what they're really looking for is to earn a share of the profits, and increasingly so purpose and social impact, but historically it's been profit, so that's why this PE ratio is so important, because it's telling you how much you have to pay for those profits. So it really is an expectation in a way of future profits, because the more you expect the company to increase its profits, the more you'll pay now for it. So you might pay a really big multiple because you think one day it's going to have loads of profits, way more than it does right now. And it's important to know that PE ratios are very relative. So each country would have its own benchmark in a way, depending on how much investors are keen to buy that, because the more keen they are to buy it, the higher the PE ratio, the more you have to pay for the earnings. Then also each industry has its own, and that's also to do with how attractive the industry is, what the growth potential is, and finally the state of the world economy. So the better the economy is doing, the more people will be willing to pay for profits because they expect them to keep going up. So the higher the general PE ratio. So that's always important to keep in mind, these factors, when you're looking at a particular company's PE ratio. You can't just look at it in isolation. So let's see the countries around the world, how PE ratios differ. So you can see here, this is just a random selection of countries. Russia has the lowest average PE ratio, so people are willing to pay the least for the profits in the companies that are based in Russia, and they're willing to pay the most for the Netherlands. And you can see all the countries in between. And then the world average is 19.4 and Europe is 18.6. So you can see that Danone, we saw, was 22.5, is on the higher side. And so the reason for these countries, as you can guess, is that Russia people are less confident in the future there, and in the Netherlands, the kind of companies that are publicly available, because these are all public companies, are ones that people think are going to grow very well. So on average, they're willing to pay quite a bit. Now we look at it by industry, and you can see that banks are on the low side and internet businesses are on the higher side. And again, it comes back down to earnings potential. So people think that on the whole, it's not such a great time to be in the banks, and they have a lot of regulatory issues, and there are a lot of neobanks and digital competitors, and it's becoming a very expensive business. And then internet and software and services, software as a service, that's the area that everyone wants to be in, and they think that the growth is going to come there. So they're willing to pay high share prices for less profits because they expect one day the profits will be higher. So now let's look at the economy as a whole, and I'm using the US stock market, which usually sets the tone, or has for the last 100 years or so set the tone for the world economy. And you can see this is the S&P 500, the biggest 500 companies of the US on the public markets, and all the horizontal grey lines are recessions that have happened. So you can see usually around a recession period, the PE ratio, which is in blue, falls a fair bit, and usually it falls a bit after this recession or around the time because suddenly people are less confident about the future. Earnings have come down and they're expecting that they're not going to come up as much. And you can see where we are now, where we're at around 23, 24 PE ratio, and historically it's quite high, but not as high as it has been. And often before big market crashes, you have very high PE ratios, and that's like a bubble. And you can see a big one in 2000, the dot-com bubble crash, and in 2007-8, around the subprime mortgage and big financial crisis, they skyrocketed. But that's also because earnings came down. So you had the prices were high, but also the earnings very low. So that's how you can contextualize the PE ratio you see of a company. And we will use an example now of Danone. Continue this example. We saw that it's currently around the PE ratio of 22. And you can see here that it's a complicated looking chart, but on the left-hand side, which is the green line, we have the PE ratio over time, and on the right-hand side is the share price, and that's orange. And you can see that that's fluctuated, so that as the PE ratio is lower, it's usually a pretty good time to be buying into this company. It's been a good long-term performer, but the lower the PE ratio, the cheaper you're buying this company. You're paying less for its earnings. So if you stuck to buying it always, at a below 20 PE ratio, you've usually done pretty well. Every time the PE ratio has come down, the stock afterwards has gone up, and as has the PE ratio. So this is a good way of often timing when you're going to invest in a company. And right now you can see it's a relatively low PE ratio for that company. It's been very high in the past, and if you bought it when the PE ratio was up around 40 in 2015, you haven't made as much money as if you bought it at a lower PE generally. So that's how to use it positively. There's also, like every rule, there are some enormous anomalies, and it's not always worth just investing when a PE ratio is low, because people are willing to pay massive amounts, massive multiples on earnings if they believe a company is going to continue to grow. And a good example is Adyen, a Dutch payment provider. And they've only been going since 2018, but their PE ratio has been enormous. It's ranged from 100 to 320 compared to Danone's 2022 on. And you can see that you could have bought it any time at this enormous PE ratio, and you still have done very well. I mean, if you bought it even when the PE ratio was 310 at its maximum in 2018, the share price was only about 650 euros a share, and now it's almost 1,300, so you've doubled your money, even though you paid this enormous amount, because people's expectations are that this company will keep growing for many years, and one day the PE ratio based on the current price, if you buy at this price and one day the earnings is enormous, will be very low. And it's all about these future expectations. So how can you, as an investor, use PE ratios? Well, the most useful considerations, I would say, looking at the company's historical PE, like we looked at Danone. So how's it ranged over time, and where is it right now within that? And how does that compare to your expectations for that business? And if it's historically low and you think the business is still going well, it could be a good time to buy. Then find out the average PE ratio for the country that it's in, or the area, the industry, and the general market to contextualize that. So generally, as we've said, the lower the PE ratio, the better, but that can also suggest that people have lost faith. If it's a tiny PE ratio of 10 or so, and people, relative to the market, it's low, it could just say that really the market knows best and the company is about to have a big reduction in earnings. And as we saw with Adyen, a very high PE ratio is not always a bad thing if people believe that the market is really going to continue loving this particular stock. So that's it for PE ratios. Thanks very much for watching the video, and see you in the next one.